Tying this all together, there are only 3 colors, 10 digits, and 7 notes. It's what we do with them that's important. Jim Rohn. I thought this was really cool because I've never really thought about this before, but when you break it down, I mean, that is the world that we live in. You know, 3 primary colors, every other color is created based on those 3 colors. And then you have 10 digits, right? Which I never thought about that, right? Because you think of millions and billions, but it's really only the same 10 digits, you know, over and over again or in different, you know, sequences. And from what I understand, that's like binary code, like for, you know, the internet and for all things like software and cloud related. It's a lot of ones and zeros and, you know, I just think it's pretty wild. And then 7 notes, right? So 7 musical notes. But then all of the music in the world, think of all the millions of songs there are, all stem from 7 notes put together in different forms and different shapes. So it's really, really amazing the world that we can create with, you know, such a very basic and small foundation, and then, you know, turn it into something magical, you know. And trading is really no different. It's a very, very creative space. That's my understanding and my experience is once you understand the fundamentals and you have a grasp on the principles and the things that you really shouldn't do, once you understand it, you can, you know, skin a cat a million different ways. You know, you can really, really be creative and create something that is your own. All right, exploiting trends to make money. We are not here to try to time the market perfectly by picking tops and bottoms, which is what a lot of people think that trading is, and that is it's a trap that people are lured to because, you know, there's a greed essence there. Is that I want to be able to get as much as I can, and it's not something that works. I think it's what people think that trading is, but it's not, and that's why it seems so risky. I'd like to think that, you know, what I've showed you so far is it's been a little, hopefully it's been very eye-opening, but hopefully it's kind of changed your perception of what you think trading stocks and these different assets and capturing profit kind of looks like, you know. So let's go over that a little bit deeper. We are here to let the assets we are watching show us where potential opportunity lies by identifying trends worth following. Our goal is to take advantage of that trend the best we can, to take a large chunk out of the middle, the sweet meat, as my friend calls it, the easy money, which I thought that was a really, really funny term, but he's like, that's, you know, like cracking open like a snow crab leg, you know. You spend all this time fighting it to bust it open, but then once you get to the middle, the sweet meat is where it's at. That's the, you know, that's the prime deal, man. That's what we're after. And so trading is really, you know, that's what we're after. We're after the middle, you know, the large chunk that's easy in the middle. You know, we can see how, you know, trends are formed. We can see that it takes a little bit of time. It usually comes from, you know, a place of transition. You know, maybe we're watching something that we're interested in and we have to let it come to us. We don't, you know, when you chase it and you try to force things, that's where you get into trouble. It's really when you know what to watch and why you're watching it, and to know what you're looking for, and you create a strategy around that, then you have what you see in the picture here. And, you know what you're looking for, and once it begins to happen, you just jump on board. It's like a train leaving the station, you know. We know this is our destination is up here somewhere. We don't know exactly where it's at, but we know in order to make money, we need to be down here somewhere. So we develop a strategy to be able to take advantage of that, and we're okay with taking money off of the table, and we're taking profits as we go. That makes the trade overall profitable, but allows us to take advantage of it while it's moving. All right, different assets, different opportunities. There are different asset classes that you can pursue. The three most popular to trade are stocks, futures, and Forex. The New York Stock Exchange generally trades from 9:30 a.m. Monday through Friday, with the exchange being closed on public holidays. You must have $25,000 in your account to day trade stocks, but most brokerages will open an account for you with an initial $500 deposit or so. I think Robinhood may do it for any amount. And so that's just kind of a general thing. I didn't really spend any time looking at this because I know that there is a lot of flexibility. Nowadays, you used to have to, open an account with $1,000 or, $500 is probably, that may be even outdated, but, that's kind of my thinking is that $500. I don't know why you would open an account with really any less than that. Just because you can't, you're very, very limited on what you can do, especially if, if you only have $500, you should be you should be opening an investment account and just starting to to buy some stocks and put it in there and just let it sit. $500 is not enough money to do much with. Futures typically are commodities, hard tradable goods that you can actually take delivery of, like gold, oil, soybeans, and lumber, etc. But they have migrated into several other categories over the years, such as being able to trade the S&P 500 index or more recently cryptocurrencies. These markets trade 24 hours a day and trade around the world. I personally love the futures market, and with the new micro-sized contracts, they are becoming more and more affordable to trade. And so I remember whenever I was first getting involved in the space and I learned about futures, and it seemed very, very intimidating because the definition and the explanation of what futures is a bit complex. There's a few things around it that just don't, they don't they don't make you at ease whenever they're explained. But honestly, it trades just like anything else. You buy it and sell it just like anything else. There's something that they call contracts, and it's essentially like 3-month periods where the most people trade it, where you can. Because the future space was originally created for hedging. And what that is that, like, let's say you're a soybean farmer, right? You can actually sell your crop before it's done, or before you release it, based on environmental factors. Like, let's say that that tough times are coming, that it's been a crappy year, there's a drought, and that could potentially drive the price of soybeans down, and that is your crop, and that's what you rely on for a living. So you can actually lock in the price by selling the amount of soybeans that you plan on producing beforehand and taking that money in the beginning. Now, the way that works is, you are planning on the price, and if you know what you're doing and you're in that business, it's pretty predictable. But if you sell something before you buy it, that means you have to buy it back at a later price. So what you would do is you would sell it first. And I know this may be a difficult concept to understand, but you can sell it first, collect the proceeds from that sale, and then as you go through, like as they would go through the season and they would have the soybeans to bring to market, they would buy back what they sold, and then you would collect the money in the meantime. And so it's another ability to produce income. Now there's risk involved with that, because if something happens and all of a sudden the drought goes away, and let's say it rains like crazy and it's a gangbuster season, now the price of soybeans is going up, and so you have to buy it back at a more expensive price, so you actually lose money. So, but that's the reason why it was created. These are things that you can literally buy, like gold. The contract's like, I don't remember how many ounces it is. Let's say it's 100 ounces. And typically you can put up a smaller amount of money. So let's say 100 ounces of gold, so that's $1,800 an ounce. Are we talking $180,000 for 100 ounces of gold, right? So you can actually trade 100 ounces of gold on what they call margin. And so you may only have to put up $5,000 to be able to control $180,000 worth of gold. So what that is it's leverage. And it's, it can be dangerous, but it can also really like kind of supercharge your returns if you know what you're doing. But then they have, all kinds of different things that you can trade. Like I mentioned, like the indexes, which are really a lot of fun to trade. As I trade the Dow Jones index for a little while, and they just have cool kind of nuances that go on with that. But they're stretching out into multiple other things, like I said, including Bitcoin and other cryptocurrencies, and it's just cool. It's more flexibility to this, to investing and trading, where you have more things that you can trade and different ways you can trade them, because not everybody wants to buy it during the day and then not have access to it at night. If you've got a lot of money on the line, you want to be able to look at it, in the middle of the night and see what it's doing. And if it starts selling off and something bad happens, you want to be able to get out, and there's nothing wrong with that. And that allows the flexibility to be able to do that. Forex, the foreign exchange or currencies market, is exactly what that means. Forex is foreign exchange, and that's currencies. Several currencies around the world trade against the US dollar. This is also a 24-hour market that trades around the world. Like futures, you can easily go long or short, make money by buying first and selling, or by selling first and buying back, which really allows you to take advantage of the uptrends and the downtrends. You can open an account and start trading with $50. So the reason why I mention that is because that's actually how I started trading Forex. I started with $50. You just change your leverage. So it's kind of like trading more or less. But you trade it to where essentially like every point that it moves is like 10 cents, right? So with $50, every move is 10 cents. So you're able to essentially scale back the leverage, and you can trade with very, very little money. So it gives you a really cool experience. So it gives you where you have real money on the line, even though it's an insignificant amount of money. It's still better than nothing. It's better than a virtual account in my opinion on that aspect. And then as you begin to either make money, or if you lose money, if you lose $50, hey, it's $50, it's really not a big deal. But moving 10 cents a piece, as long as you're not, scaling up the leverage, then that 10 cents, then that $50 can actually last quite a long time while you're learning the nuances of how this works. And then the other benefit is that you can add more money to it as you continue to grow. And let's say you're starting to make money, you can now add money to it, and then you can add leverage. So it's just, again, it's another very flexible thing there. We talked about uptrends and downtrends, right? Stocks, generally you're only buying, right? The only time you're selling is whenever you're taking profits or you're getting out of a losing trade. In the Forex and future markets, when there's a downtrend, like let's say something happened, the stock market's crashing, right? And that it's from what your experience is that that it's going to be going down for a while, and that could be anything. You could be like, just like we looked at lumber, right? We knew when lumber was going up to, $1,000, $1,500, $1,800, we know that's not going to last forever. That's just the circumstances of the time. Well, instead of just having to sit and wait for it to come back and buy it back at a lower price, you can literally start trading, which is what's called going short. And which, again, like I mentioned, that's how you make money on the downside. You sell it at a price. So lumber went to $1,800. So let's say it's come back down and you sell it at $1,600. So now, as long as it continues to go lower, you are making money, because if you sell something for $1,600 and you buy it back for $1,200, you get to keep that $400 in between. So it just gives you more flexibility to be, if the market's going down, you can make, and you got a strategy for that. You can make money when it's going down. Same thing as going up. So it gives more flexibility there too. And a lot of that was whenever I was day trading. And so I think it just gives you more flexibility there, because the stock market is generally driven just to go higher. Unless something's wrong, there's some sort of crisis or there's bad news or whatever else, a lot of people, because of the way that investment flows there, people expect that to continue to go higher and higher and higher and higher. So actually going going short and selling into the market like that, because you can do that with stocks as well, but it's much, much sketchier, and I don't recommend it.